Well, hello everyone. Glad to be back and somewhat recovered this week from my unexpected battle with COVID last week. After being careful for 2 years and fully vaxxed, and I thought, okay, I'm going to go to the Leaf game. I'm going to be in a corporate box. It should be just fine. Anyways, it turns out this variant apparently it's just going to get everybody eventually. So. Was the worst 4-day headache I've ever had in my life, and I couldn't imagine how bad it would be if I didn't have the vaccine. And in any case, so glad to be back, folks, and sorry to have missed an event last week, but you wouldn't have wanted to see me on video or hear me try to speak. Our educational efforts here in Canada, with our partners, BMO. Few years ago, we decided to make use of YouTube to house all our information, and the feedback that we get provided from our audience is great. So everyone seems to like the format and everything else, which is great. And I think we talk about traveling again and reopening, and I probably don't see it in 2022, but hoping 2023 we'll be able to get back out there on the road again and start to see people face to face. But it's really going to be up to you guys to let us know in terms of live events and whether you're comfortable coming out to them or not. My recent experience with a live event wasn't great, so still apprehensive at this point. So again, thanks again to our sponsors and our group of companies and everybody we're involved with to produce and come up with these events. I think the next couple years will be very, very interesting, in terms of markets. Not that there aren't always interesting. There's always something to talk about and to whip the markets around. One of the great things of dealing with a partner like BMO ETFs is their effort in their educational efforts. And all these events that we put on, again, are free of charge. And we ask that you do help us in support for a couple of the charitable efforts that we have. Many of you have made donations so far. Thank you very much for that. And again, thrilled to match them. Cancer research at Sick Kids Hospital and dementia and Alzheimer's at Baycrest Hospital here in Toronto would be greatly appreciated. If you use the link that comes out with the email following the event tomorrow, we can track your donations and match them. So do what you can, and we know it's tough out there. Our special guest this week from BMO ETFs, Annabelle's been with BMO for 9 years now, but relatively new to the ETF team. She's had various functions, but pretty quickly coming up to speed on the clarity and benefits of ETFs. So tonight she's going to focus on a lot of the benefits, including transparency and liquidity and ease of use. So Annabelle, over to you to spend the next 10-15 minutes talking about some of the benefits of ETFs.
Thank you so much for having me here tonight, Larry. Tonight actually marks my first time here on Investor's Guide to Thrive, and I am super pumped to be able to share my ETF knowledge with everyone who is joining us tonight. The ETF industry just keeps growing, and that at such a rapid pace. In Canada, today, the ETF industry has grown to $297 billion in assets. The actual number of ETFs available to investors has more than doubled in the last 5 years. Now, those numbers are astonishing. ETFs are backed up by such powerful benefits, and oftentimes these benefits are just simply not acknowledged. ETFs provide diversified exposure at a low cost. They are traded throughout the day, which provides added flexibility. And over the next 15 minutes, we'll be covering the benefits ETF have to offer to end investors. Understanding the benefits behind a solution is a key element in making informative decisions. Really, it's the core of investing, and it is such a crucial element for one to become a successful investor. Before we do take a deeper dive into tonight's topic, I would like to start with a brief disclosure and remind everyone watching tonight's session I am in no shape or form providing any investment recommendation or giving any investment advice. Tonight's session is purely only for educational purposes. I see you have the slide up on the screen, so now let's have fun and jump right into it. First up, we got transparency. This is one of the key features which people don't really care about till it really matters. When it comes to an ETF, investors know exactly what is in them. They know the exact exposure they have within the ETF, whether it's a specific exposure to a sector or a specific holding. When doing your due diligence with an ETF, there is no secret. ETFs tend to offer better transparency into their holdings than actively managed funds. They provide the ability to verify your position on a daily basis. Basically, on a daily basis, ETF providers are mandated to update their ETF holdings, and that down to the very last holding. So this is a standard across the ETF industry. This is not something that is unique to BMO. Oftentimes, an active strategy or an active fund will be less transparent with their holding, as they are only updated monthly. Transparency really allows an investor to know exactly what investment they're holding in their portfolios. It creates an ease of access. ETFs really take the guesswork out of diversification. Compared to individual stocks, there is a lot less research involved for the end investor, which it could also lead to a lot less stress and just simply having a better understanding of your portfolios. Investor may wish to gain quick portfolio exposures to specific sectors or industries or countries, but they do not have all the needed expertise for these areas. Given the wide variety of sectors or industries or countries available, ETFs provide an investor with easy exposure to a specific desired market segment. One of the top reasons for choosing an ETF over a stock would be instant diversification. For example, purchasing an ETF that tracks an index gives you ownership to a basket of security versus a single company. By owning a basket of security versus owning the individual stocks, you're potentially reducing your risk exposure. And as the old cliche goes, we don't want to put all our eggs in one basket. And as we move ahead, up next, we got liquidity. Liquidity is most likely one of the most misunderstood benefit an ETF has to offer. When people do start using ETF, they are accustomed to looking at the volume of a stock and think, well, the more the stock is traded, the more liquid it is. Given these emerging characteristics, investors who are most familiar with traditional stock trading are raising concern about the investability of smaller ETFs. Well, to address these concerns, it's important to note that the traded volume of an ETF does not measure its liquidity. While the liquidity of an individual security is directly related to the traded volume of that security, the same correlation does not apply to an ETF. Even though ETFs are listed on an exchange and are accessed in the same manner as a stock, there is a key difference. ETFs are open-ended and thus have access to the liquidity of the underlying holdings. When it comes to an ETF, it is very different than a stock. The liquidity of an ETF is driven by the underlying holding of the ETF. Therefore, as long as the underlying holdings are liquid, it's easy for the market maker or the portfolio manager to create additional shares. That ETF itself will be liquid. ETF liquidity has two components: the volume of units traded on an exchange and the liquidity of the individual security within the ETF itself. That being said, the more the ETF is traded, the more liquid it will be. To help us better understand this concept of liquidity, let's use the S&P 500 as an example. There is a lot of S&P 500 out there on the market. The average bid and ask spread on these ETF are even tighter than the weighted average of the underlying stock. Reason being, it's because they are traded so much. If we look at the AUM of ZSP up here on my screen, this ETF alone has over 10 billion of net assets. Now you're probably asking yourself, okay, Annabelle, but why does that even matter? Well, you see, this matters because typically the larger the ETF, the larger its user base will be. Chances are, if you are buying and selling an ETF, you're buying it from an ETF seller. There's the primary market liquidity, but there's the additional layer of liquidity that is trading off the ETF's unit that provides the additional liquidity. This is even more liquid than the underlying. One thing to keep in mind for those even bigger ETFs, the more the ETF is traded, the more volume it has, the greater liquidity it does have to offer. In conclusion, ETFs are liquid. Your best bet when looking at a smaller ETF would not be the volume to know if it's liquid. It would be the bid and the ask, and that is determined by the underlying holding. And oftentimes, some ETFs are even more liquid than their underlying holding. For example, a bond ETFs. Bonds are not nearly traded as much as bond ETFs. As we move along, we all know that we all like to save a bit of money when possible. ETFs are cost-efficient investments. ETFs tend to charge much lower management fee and expenses than many other investment options. Lower costs means you have more of your money working for yourself over the longer period of time. By purchasing an ETF, an investor avoids the commission cost they would normally be paying for purchasing each individual security. Like a mutual fund, an ETF has a management fee. This is basically the cost of running the ETF. However, ETFs have much fewer operational expenses, and that translates into lower expense ratio for investors. As an investor, your total cost to purchase an ETF would be the MER, together the operating fee and the management fee. Whether it's for an ETF that is more passive, such as ZSP, or something more active, such as a cover call that provides you with an option strategy, the MER are still much lower compared to other investment vehicles, thus making ETFs a cost-efficient strategy. Another good example as to show a cost-efficient ETF would be purchasing ZGRO or ZEQT. They are rebalanced quarterly, they both offer equity and fixed income, and that all comes within one trade. As we move along, I know we have a lot of Canadians joining us on tonight's calls, and Canadians are often looking to buy stocks outside of Canada. For Canadians, when they invest in non-Canadian assets, there's one thing to keep in mind, and that is there's two strains of return. There's the return of the underlying asset, but there's also the return of currency. For example, you could invest in ZSP, which is the S&P 500. It could be up 10% that year, but if the US dollar was down 10%, your net return would be close to zero. One of the unique features of an ETF is that it allows investors to invest in multiple formats. There's ETFs that have exposure to both currency and the underlying shares, so you get both screens of return. But one of the innovations that came from the Canadian market is that there is currency hedged ETFs. So for an investor who wants the exposure to the underlying market, but not the currency returns, there's currency hedged ETFs. ETFs offer a wide variety of different options for currency. Canadians have access to 3 different currency options when using ETFs to invest in non-domestic equity. So Canadians do have a choice. Again, let's use the S&P 500 as an example for a point of reference. Investors would be able to invest in local currency exposure by investing in ZUE, the hedged to Canadian option. Or they could invest in ZSP, the unhedged option, or there's also the option to invest in US dollars by going with ZSP.U. If you're someone who has US dollars and are looking to invest in a non-registered account, for example, you could invest in ZSP.U. It is traded on the Canadian market, but it is not subjected to US estate taxes, nor must you fill out the T1135 verification form. That is one of the benefits that you do get by buying an ETF that is on the Canadian exchange. All of these three options are available at no additional cost. And then in terms of benefits, last but not least, there is size and efficiency. Another great thing of an ETF is that they are often easier to purchase than these high price stocks. For example, Amazon closed at 3,155 US dollars per share today. That is a lot of money. And this feature is a feature that people tend to often overlook. When you look at an ETF, the cost of purchasing the individual ticker is oftentimes a lot lower than these big name US stocks. When one is investing in individual accounts, if you're acquiring dividend or cash in hope to purchase these individual securities, such as Amazon or these other big name companies that you have up on your screen, you will need more capital. But with an ETF, the NAV tends to be lower. Might not sound like much, but since you are able to put that cash to work faster, because the price is so much smaller, you will be able to put that capital to work much faster, which is a huge benefit ETFs have to offer. In general, ETFs will normally range between $30 to $100, which will also ease the process of rebalancing the allocation of your portfolio or specific holding when needed. As we are approaching the end of my part for tonight's session, I would like to offer a few pointers to investors at home. Tip number one, markets tend to be more volatile at open and at close. The market price of an ETF reflects the underlying portfolio's value. Therefore, try to avoid trading the first and last 30 minutes. This will allow enough time for the underlying portfolio to start trading. Tip number two, when possible, use limit order. When trading ETFs, the entry and exit trading price will impact the trade's overall profitability. The underlying market level continues to move while a trade is being placed. A limit order can ensure a desired price on a trade. You will know exactly how much your trade would cost you. You'll know the exact total. Limit orders are good. You're setting a price. You have an expectation. In an event something was to happen in the market, there would be no surprise. And lastly, tip number three. When it's possible, trade when the underlying markets are open. The underwriter will be able to keep a tighter spread when the underlying portfolio is trading. The ETF's price can be precisely calculated. When the underlying market is closed, the underwriter will have to model the price and will therefore set a slightly wider spread to reflect their increased risk on the trade. So it's simple. When it is possible, trade when the underlying market is open. If it's a holiday, for example, in the US, consider placing the trade the next day. As for European markets, try to trade between 10 a.m. and noon. Typically, those are the best hours to trade. This concludes my part for tonight's session. I would like to thank everyone who took the time to hear me out. I really do hope you enjoyed yourself as much as I did. I would like to invite everyone to subscribe to our ETF Market Insight. My wonderful colleague Alfred and Danielle do such a fantastic job at discussing market insight. It is every Friday at 1 p.m. Eastern Time, and tomorrow's session will be covering interest rate. And I have no doubt in my mind that the topics being covered will be of interest to every investor who has joined us tonight. Once again, thank you so much for your time. Larry, back to you.
Thanks so much, Annabelle, and a great first effort from you. So we'll look forward to having you back again. Okay, and tomorrow's talk with Danielle and Alfred should be very good as well. I've got a little slogan on my shirt. I'm going to stand up here. I specifically wore this. Money is made by discounting the obvious and betting on the unexpected. George Soros from iBillionaire. So, when it comes to looking for opportunity, my mindset has always been, buy what's out of favor. As long as there's a catalyst for that disfavor to turn, it's usually a good plan. And I'm going to talk a little bit about in terms of transparency this week. I'm going to dig a little bit into my own methodology and portfolios, as I often do here. First, we're going to take a little bit of a dive into the geopolitics of the world and some of the things driving inflation. I talked this week on the show about a report that was put out by Zoltan Pozsar. Zoltan is I don't know him, I've never spoken to him. I've been following his research for a number of years now. When I talked to my old hedge fund colleagues when I was on the sell side of the street, when I worked for CIBC World Markets and I had clients, and I've kept in touch with many of them over the years, everybody reads Zoltan, and he's very influential. So his report this week was a bit of an eye-opener. I thought I would feature it on the show. I'll dig a little bit into that today. But ultimately, we're likely in an environment with higher inflation than we're used to, and less globalism. And that's going to matter for your portfolios. And so 2 weeks ago, before I got sick, we talked about making your portfolios boring for a little while. And I'm going to give you a lens into my portfolios a little bit. I'm going to talk about that ETF that I highlighted this week in the US, Buy America, and we'll take a deeper dive and have a look at that, and hopefully give you some ideas this week. And unlike Annabelle, this is investment advice. I don't know any of you individually, so govern yourself accordingly. But the goal here is education, and no, I don't expect everything I say for you to go out and buy the next day. In fact, don't do that. What I'm trying to do, and the efforts over the years, has always been to teach our viewers how to do it a little bit better, how to take some of the mistakes that I've made over the years. And every time you go through a market cycle, an up and down, an event, you learn something about the decisions you made. And in order to become better at what you do, you've got to always look back and say, hey, I believe this at the time, but this happened, and why didn't I understand that? And how could we do it better the next time? What we're going through now in terms of geopolitics is, it's mind-numbing. It's disturbing. There's been parallels to the U.S. incursion into Iraq. Iraq's incursion into Kuwait. There's all these, historical events. A lot of talk now around World War II, and because it's centered in Europe, and some of the players back then are involved, and it's a different world than World War II. Nuclear capabilities, mutually assured destruction between Russia and NATO that are both equally armed. We had decades of a Cold War, and Yeltsin, who was kind of pro-West, and the wall came down, and Putin didn't like that. And him and some of his cronies have fought for decades to reconstitute what was the Soviet Union, and so America at points in time, you didn't help their own cause. They did and still do try to westernize the world. And in some parts of the world, they don't want to be westernized. And we have the lens that freedom and open governments and that is the way to live. And in other parts of the world, that's not the case. And again, I think, and we hope, neoliberalism kind of wins the day in the long run versus autocratic governments and closed systems and disrespect for freedoms and so forth. But not everybody in the world, has that lens. And so this causes a lot of geopolitical inconsistencies in the world. And so whether you look at impacts of the currency crisis that came from Russia and emerging markets in '97, the great financial crisis that came out of the US and bad lending practices, the shock to the world in COVID. What Zoltan brought out in his paper was this one is very different, because how they started to fix a lot of those other ones. Those who remember the long-term capital debacle, that was the first time Greenspan called all the other central banks in the world. I remember I was a strategist on the CIBC World Fixed Income Desk at the time, World Markets Fixed Income Desk, and the conversation at the time was about, what is he doing? You got every central bank in the world lined up to cut interest rates at the same time. And, so what's going on now? And Zoltan says it in an interesting way, but you can print money, but you can't print oil to heat or wheat to eat. And the energy markets and the food markets we've talked about in recent weeks are a key part of that part of the world. And there's impairments there. And Zoltan talks about Bretton Woods 3 and the new monetary regime that we're going to see in the future, and tries to present a lens. And the lens is effectively trying to make the link between QE and then the inflationary impact of this conflict. So, wars historically have been very inflationary. What he's arguing now, and the rebalancing of the world, the East-West, the China-Russia alliance, early in February, just before the Olympics, or as the Olympics were starting, I believe Putin went to Beijing, and they opened the Olympics, and they had this grand statement that Putin supports China's quest to control Taiwan and Hong Kong, and China in turn supports the reunification of the Soviet Union. It wasn't that clear in the message, but that was ultimately the tone of the message. And so this we've got a new Cold War. Right now it's a bit of a hot war, and it's a tragic hot war given the human toll. But what Zoltan's trying to present to us is a lens by way of a permanent restructuring is going to add to price instability and therefore financial instability. And anyways, I put a link to the paper. I encourage you to read both of them. Google around, find it. On the BNN web blog this week, I put it up as well. And so I think it's the right lens. I think he's onto something here. So he talks about global shipping as and he's trying to equate it to the time value of money, and in terms of the cost of interest. Time is money, as we know that phrase. The time it takes to get cargo from A to B, all this kind of matters, and it relates to leasing, it relates for demand for dollars. So Putin has started to demand payments for Urals being the brand of oil that Russia produces in ruble. There's the Chinese central bank digital currency, where they're going to be able to bypass the world of commodities that largely trade off the dollar basis. And so the world is changing. And I've said for decades, really, I've literally said this since the euro was created, and everybody said, oh, the dollar is going to hell and in a handbasket. And there was a period where the euro got very, very, very strong and the dollar was very, very weak. But ultimately, Europe didn't work, because you can't have monetary union without fiscal union. And now you're starting to see the fiscal union in terms of what they've had to do to support the pan-European mandate and keep them all together. So, you do have a pretty dramatically changing world. He talks in his paper about, protection and as insurance. And so when you talk about protection of interest rates, you have swaps and you have interest rate, you have a whole infrastructure system, floating and fixed, LIBOR rates, and you've probably heard some of these terms, and many of you may not be, depthly an understanding of them. But effectively, the funding world, banks and lending, they fund themselves in the floating rate market, the money markets, and they lend fixed, they lend long, borrow short, lend long. And he's trying to make the equation between what's happening to the commodity markets and why it's more permanent now. And so he talks about the restructuring of the supply chains for oil and the limitations and kind of what it means. Again, strongly encourage you to read. I try to summarize it here a little bit. But as he gets into some depth about the 1.3 million barrels a day that get shipped from ports that for now, they can't get insurance because no one's going to insure the ships. It's in a war area. These areas that service these ships are using the Aframax carriers. And so these ships are the smaller loads, but faster. So they can take within about 2 weeks these 1.3 million barrels of crude and get them from where they're put on ships to Hamburg, to Germany, basically. Now, if the West is not going to buy that oil in the long run anymore, and I think that this is a decades that this could last, certainly as long as Putin and Russia support what's going on in their thinking of rebuilding the Soviet Union. So he does some math here, and he basically says that 10% of the very large ships that move capacity around the world are going to be useless because of the time it takes to get oil that took 2 weeks to get it to Europe. That's now going to take 2 months to get it to China, but then 2 months for that ship to come back. And so 4 months before that oil, 1.3 million barrels, hits GDP, right? Hits the productive side of the energy that's creating for cars and whatever. So that whole restructuring has all these knock-on effects. And then there's the food that comes from that side of the world that has on all these knock-on effects. The wheat that 70% of the wheat that Egypt gets comes from Russia and Ukraine. And if that wheat can't get to Egypt or takes longer, it's just going to be more expensive. And so oil going through the Straits of Hormuz that are going to have to come in these big ships now, these big ships can't go through those ports because they're too deep. So what they have to do is they have to offload half the crude, 1 million barrels of the 2 million, store it, push the ship through, and then pump it back in on the other side, and then it can go through. So how much more does that cost if they want to use the same ships and so forth? So you've got these challenges, and effectively what he's saying in all of this, it means we're going to have less dollarization in the world as we restructure, and that's going to mean a lot for interest rates. One of the luxuries that the US government and economy has had for decades and may no longer be is the financing of the US, massive US deficits. We can talk about the Canadian budgets and the deficits here a little bit later if we have time. That the trade that goes on with that side of the world that's going to be lessened is going to mean lesser demand for treasuries and dollars and reserve currencies, and more demand for hard assets and gold, and so it's a rebalancing. There's nobody, or very few people, me included, that were investing with any prominence or experience during the 1970s, the last time we had, these type of inflation considerations. We don't know. We think it's transitory. We hope it's transitory. My good friend David Rosenberg says it's transitory. Lots of people think it is. Some people think it's more permanent. I don't know. I think it's transitory. I think a shock to the economy will slow things down. I think we've hit peak demand for oil. We'll see a lot of these things, but the food channels, like everything's got to rebalance. And then there's the onshoring. There's the Buy America. There's the just-in-time inventories. They're going to have just-in-case inventories. And all of that is going to feed inflation and inflation expectations. And so you have this trend that's been in place for decades. The green line here is the 10-year average U.S. Treasury yield, and the pink line, purple line, is the 25-year average yield. And so that is a very, very important dynamic in what's happening here. But as it pertains to inflation expectations and how the core part of inflation has behaved for decades, you can see core personal consumption index here. This is the PCE that is linked to how they calculate real GDP in the US, personal consumption expenditure deflator. And we've now seen the average 10-year price move up through the average 25-year price. The last time that happened was in the 1960s. So I don't know if this is a blip, but it's the biggest blip we've had in decades. And for all the talking heads, including myself, we haven't managed through this. We can go back and look at history. We can kind of say, well, that happened then and this happened. And everything I've seen, or mostly everything I've seen recently about inflation and shocks and yield curve, has gone back to the inflation of the 80s and 90s and 2000s and 2010s, and completely ignored the 1960s and 70s that may, because of these transitory or these more permanent structural changes in the world, that may put it up a notch. So maybe it's not 1 to 2%, maybe it's 2 to 3. Let's hope it's not 3 to 4, because all the debt in the world that's been accumulated by governments that don't get it and don't understand balance and made promises and want to get elected. Doug Ford here in the States, when he was trying to get elected against the Liberals, balanced budget, pound, pound, pound. Now COVID happened and whatever. But now what is he doing? Today there was another, we're going to cut your gas tax. So it's an election buy. I just got a check in the mail as a rebate. This isn't it, but as a rebate from, the license plates, an election. So how governments try to get elected, and they promise you things. And today's budget was a lot of what was promised in the last election, and delivered on because there was an agreement between the parties and so forth. So I think all of this, the way we're moving politically, the way the world is onshoring, is going to lead to a higher average level of inflation, and the capital markets, bonds and stocks together, are not priced for it. I'm not forecasting a recession. I'm not forecasting a bear market. I'm not forecasting any of that. What I'm saying is, and what Zoltan was saying and presented a very, very, nice and succinct view of the new monetary system, where inflation, which hasn't been a consideration for decades, now is actually got to be a primary consideration. Again, equity markets aren't ready for this. They're not priced for this. What does it mean? How do you govern yourself? I'm going to spend the rest of our, next month or so, what we've got left in this series, trying to give you ideas and that to deal with this. So what is likely? I look at things. Not what will happen. What is likely going to happen? So whether it's Trump, whoever's going to lead the GOP in the next election, or Biden, buy America, buy Canada. It's going to be a lot less globalism and more domestic. And that just might mean that the growth areas, and some of them, not all of them for sure, but the growth areas of the last decades may not be the growth areas of the next decades, to the extent that mid-cap and small-cap companies tend to be more domestic than large-cap companies that tend to be more international. The big tech companies sell their products all over the world, but a small-cap stock that has $1 billion valuation, and you would think $1 billion company is big, but by definition, small company, probably doesn't have much of a footprint outside the United States or in Canada. $500 million value company probably doesn't have much of a footprint outside of Canada or North America. And so perhaps the demand for products from local companies are better. And so when you look in, so this ETF, I was screening for, what do you buy if this is your thesis? And so I came across this ETF, and it was launched just around the 2020 election. And maybe it was launched, buy America, make America. I don't know what the motivation was, and to me, it doesn't matter. But when you look at the value of it, the PE, the price to sales, price to book and cash flow, and this is attractively priced on average, mid, not large, but there's some mid and small cap names in here. And, that's kind of interesting to me. And what sectors do you get when you buy America? So how much technology do you see here? Well, not a whole lot, right? So it's a different lens. And so what I want to do now is I want to dig into this ETF, and then I want to put my lens on it and how I look at it. I understand that many of you don't have these tools that I have. And as a professional investor, listen, it costs money to do a lot of research. And that's why if you're working with an active manager, you got to pay a little bit more than working with the low cost, efficient, transparent, diversified liquid ETFs. And you can choose. And I started a business called ETF Capital Management because I believe that most active managers don't beat the index. They don't. It's a fact. And certainly not all the time, the ones that do. But I think we're also heading into an era. While I think ETFs are fantastic, I think we're and again, I'm going to get chastised because I'm thought of as the ETF guy, but I think we're getting into an era where picking stocks is going to be interesting again. Now, how you pick them and how you use them can actually be done with computers. And I believe ultimately in the long run, computers are going to run every portfolio. Now, for every active manager today, I can guarantee you, like with myself, there's a computer network behind me crunching all these numbers. Now, at the end of the day, I'm the portfolio manager and I'm active, so I can charge a little bit more for it. But at the end of the day, I'm using computers and technology. And at some point, with artificial intelligence, I started going down this path a few years ago, and I've talked about it over the years. COVID kind of put that project on hold for us, but ultimately we'll get back to it, where augmented intelligence is going to be able to help us build portfolios and deliver them to investors, efficiently by way of ETFs and maybe active mutual funds. So here's one of the lenses. This is not all inclusive. There's 20 other factors that I look at when I'm looking at an ETF. So I've taken this ETF and I've exploded it out, and I've broken it down by its industry groups, sub-industry groups. And you can see when you break them down by sectors, so you've got your consumer discretionaries and your staples. And so I'm going to run through them all and see what you get. But when you look through this list, I can guarantee that most of you aren't going to have heard of many of these companies. Certainly some of them, everybody knows. Not everybody. Hershey's, right? The chocolate company. Not everybody knows Hormel Foods, but if you mention that, they do this, a lot of people know Campbell's Soup. Tyson Foods, one of the largest meat processors in the world. ConAgra, agricultural meat processor, wheat kind of thing. So a lot of these names, some of you will know, and many of you will have never heard of them before. Small mid-cap companies, more domesticated and so forth. They're not the exciting names. These are the boring day-to-day companies we rely on to live, to eat. And I think we're going for a little while anyways, and we're under inflation, where it's going to be more about what I need to live off of, not what I want to consume world. And so a little bit less growth and a little bit more boring is going to be interesting. So one of the things that I insist on when I'm looking for an investment idea is value. I have that value hat on. So one of the comparisons I make, it's really hard now given COVID and what that did to PEs for a lot of companies that were more impacted than others, kind of throwing those metrics off. But you kind of look at, what is the average that this trades at? So right in the middle there, you have the 5-year average PE, and then you have the current BES. So that's the Bloomberg estimate. And what they do is they take all the analysts that evaluate the companies, they roll up their average earnings estimate and price targets and so forth to create a weighted average target and so forth. So, I'm looking at the price targets. So the best target price, I want at least 20% upside to that 1-year analyst, what they think it's worth on average. I kind of do a bit of a look through. The analyst rating is 1 to 5. How many are buy, hold, neutral? So I look at a lot of these factors. I look at how sensitive the company is, its beta and correlation to the S&P 500. So recreational vehicles that are more cyclical in nature, certainly made in America because they tend not to make a Winnebago and ship it to Europe, although they probably do some of that, tends to be more of a domestic market, and so forth. And so the sensitivity is the beta to the index. The more cyclical, home building, more sensitive, it's going to have a higher number. The lower the beta, the lower the sensitivity to the broader market. The lower the correlation, the lower that number, the lower how less it's correlated to the broader market. And so you can look for companies that the lower these betas and correlations are, the more idiosyncratic they are. And what that crazy investment word means is the more that what the company does affects the bottom line and the returns than the macro, than the market influence. So the less correlated it is, the more individual it is, the more different than the index it'll be. And so if you're going through a bad economic period, you want companies in general that are a little less correlated and less cyclicality and sensitivity. And so that's kind of what I'm looking for when I'm looking through this lens. So question is, do I want to buy this ETF in the ETF portfolios that I work? And so I do the analysis and I look under the hood and I say, how many of these names, if I was buying these individual names, would I buy today? So how many of them have at least 20% upside in price target? How sensitive are they relative to the index? And you know, if I am running my ESG fund, I have that ESG lens. And then currently, are they overbought or oversold? I have a bunch of indicators I look at, but the one that most people understand is the RSI, the Wells Wilder RSI index, and so the Bloomberg ticker as the is the RSI, INT RSI there. So I'm looking to when I'm adding something to my portfolio, I'm looking for all these metrics, value. I'm looking for the right timing of it. Beta matters, but a bit of it doesn't, because when I'm looking for a solution is, you know, what's the best one to buy today? So I'm going to give you a little bit of that lens. And so one of the ones that we're going to look at is Sky. You know, actually, folks, to be very honest with you, it's not a stock in my universe of home builders. I tend to stick to the big names. And so I started to do some research on it. So how do I start to drill down? And as I'm drilling down, I look at it. So what do they do? So these people are making factory built houses, you know, modular homes. And so this is, you know, at the very low end of the affordability range. And as house prices and interest rates go up, there's going to be probably more demand for this kind of housing and so forth. And this could potentially be, you know, a pretty good growth industry. And so, you know, you kind of do that. And then you kind of look at, well, what are the analysts thinking here? And if you look at some of the names, you know, it's only covered by one of the Canadian companies, it's RBC there. And some of the names, maybe you don't know some of the firms there. And so, you know, there's no Goldman Sachs coverage here and whatever. And so there's seven coverages. Their average price target, I kind of look at when did they make that last rating. So some of the analysts that were neutral on it, hold neutral, they think it's worth around 70. And the ones that are bullish on it are in the 80s. People who kind of ranked it a few months ago were in the hundreds. Things change. So, you know, on average right now, you know, high 80s, maybe you want to discount that a little bit towards 80, maybe 75. It's currently trading around 50. I've got the upside potential I look for. So what drives this? What's going to turn the story here? And that's kind of how I think about it. And do I want to add this name to my portfolio today? And then I bring the charts out. So I figured out that this is a company that I could potentially want to own. As it was growing, coming out of COVID, and you can see the red line there is that analyst price target, and it would rally up to the price target, and it would sell off and come back, hit the moving average, then rally up to the price target, sell off, come back, rinse and repeat. And so a name like this, you don't want to buy on strength or on a breakout. It has this characteristic of once it kind of hits its price target, it goes sideways or corrects. So you want to buy the correction. And so let's look at the current correction. It's the deepest. And so why is this stock getting hit harder now than the last few years? And it's because a few months ago, the Fed started talking about raising interest rates and putting the cost of money up, and the affordability of housing now is in question. So the PE of this stock, when it was trading at $75 or $80 a few months ago and at the price target, you don't want to own it. That's not the time to own a name like this, unless you believe, obviously, it's going to get better. Relative to the index, the pink line here, you can go back when this index was at 100, it was equal performance to the S&P 500. And now that index is at 300 and change. It's outperformed the S&P by 300 and change. So now it's coming back to trend and a relative trend, and I want to buy. If it's a name that I want to own, I want to buy it when it's oversold. And so this is a name that I'm starting to get interested in. Haven't bought it, but it's starting to meet the criteria. And so, you know, what's the catalyst here for when I want to buy this, and how oversold could it get? And the reality is it can get very, 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 very oversold. So if I were to purchase it today, and you know, when people call in on BNN, all this stuff goes through my head. And they ask, so how much would I buy today? So if a full committed position for my portfolio is about 3%, 3.33 to be exact, 30 stocks, equal weight. How much would I buy today? And the answer would probably be around 0.5%. On the average, 1.5% is pretty much in the higher environment where I think market correction risk now is really high. So the beta risk is really high right now. I want to be more diversified. I don't want to have concentrated bets, because if you're wrong, you get to be really wrong. And it doesn't give you a lot of flexibility. The more diversified you are, the more bets you have, the higher your probability of success when you want to play defense on average. And so that's my lens right now, folks. So let's dig a little bit further into the ETF for some other ideas. So further on, now we're getting into some of the other sectors, healthcare, by United Therapeutics, Emergent Biosolutions. I never heard of them. Encore Wire Corp. So you're getting into a bunch of companies that, okay, so what's Encore Wire? What are they all about? Let's do some research on there. So when we look at these companies, the one that stood out to me here in the building materials. So I've seen a theme here, and when you look through the ETF and you say what's getting hit the hardest and what's most oversold, it's the ones that are linked to the housing sector. And why are those getting hit really hard right now is because of rising interest rates. And so when is that all going to be priced in to the market? Well, on the short end, probably midpoint next year. If we looked at the futures curve on the expectation for rate hikes, the euro dollar, the LIBOR curve, has the Fed aggressively and actively pushing up short-term interest rates to around 3% by the middle of 2023. And you've all heard them get a lot more hawkish and start talking about 50 basis point rate hikes. But shortly thereafter, starting to cut rates. And the only reason the Fed would do that is that their hike cycle pushed us into a recession, and now they have to cut interest rates. That's a fact, folks. I'm not forecasting that. That's how the money market today is priced. And so when everybody's out there saying, I don't think we're going to get a recession, the market right now says we're going to get a recession, okay? Parts of the yield curve have already inverted, and that narrative, is out there, and maybe we can take a little bit of look at that at the end if we have time. But so I wanted to again dig into this name, and that jumps off the page to me here, Simpson. So again, a company I don't know, it's not in my universe. Let me find out a little bit about what's going on and what do these guys do. And so they manufacture wood to wood and concrete and masonry products, so building construction. So, it's clear that these guys, domestic, but right now in an environment that is not friendly at all to home builders. So we're at a point now where we're starting to see blood in the streets. And if you're looking for bargains and value, you kind of look through this list and say, is there a name here that's a pretty good dividend payer, that's got a pretty good PE? So I look at this on a PE basis, and it's still trading a little bit expensive relative to the history. And I look at some of the growth metrics, and it's got some pretty decent growth metrics here, and so it's on the radar, but it's a name I don't know. I got to get used to it and how it trades a little bit and so forth. But right now I don't own this name. Again, what do the analysts think about it? How much is it worth? Trading at a little over 100 right now. Most recent updates were a month and 2 months ago. And again, 2 months ago, the Fed wasn't as hawkish. It was going to be measured and slow, and they had the tools, and it was a soft landing. And now we're talking hard landing. So these price targets will need to change. And so I would say, how much do they come down, and is there enough there? And today, then, we don't have enough, and I wouldn't be buying this. And so there's that type of analysis before it gets to the charts that I do. So this meets my criteria, it's oversold, but right now lacks a bit of a catalyst, and that price target probably comes down. The last earnings report in February, they beat earnings. I'd want to see their next earnings report. I want to see what they say and get a sense of the company a bit more. And so I would avoid it right now. And again, further dig down, let's look at some of the other sectors. So we get into the materials area here. You can see on the industrial side, BWXT is a company that is in my universe. I was buying it below 50, buying it all the way down to the mid 40s or upper 40s. I'm a seller of this in the upper 50s. I have a position in my yield fund with a covered call at the moment on it that we had written puts on some point last year. So some of these names, come into the portfolio that we know. Vulcan Materials is in my universe and so forth. WestRock is in my universe in terms of containers and packaging and so forth. So again, looking at this, what names kind of here jump off the page to us and kind of what we would want to look at next. So here we've got Eagle Materials. And again, these guys, gypsum, wall boards, recycled paperboard, concrete, these guys are in the home building and building area. And again, so that theme is jumping up. Now there's a home builder ETF, XHB. And so that's now on my radar. Am I buying it today? No. But it's oversold. It meets the criteria. But it's now something that in the next 3 months, it's probably cheap enough and interest rates are high enough and all the bad news on where earnings are going to be 6 and 12 months from now for a lot of these guys because home building may be slowing down. But here's the thing with home building, immigration and demand, and there's actually not enough of it. And one of the reasons prices are skyrocketing, in addition to all the money sloshing around, is a lack of inventory and supply. And so on the low end of the housing market, I like the low end housing builders, DHI as an example. And we've got that Sky builder on our radar now too. So again, this is kind of the things we do and when we're looking for investment ideas. Again, meets my criteria, 20% upside, oversold relative. Am I going to buy this today? And again, the answer is no. Do I own any home building exposure? I do. I own DHI in my portfolios. I'm about 5% underwater on it. I'm currently maintaining my exposure. So as it goes lower, I'm adding to it, not adding to the size, but maintaining the weight of that stock in my portfolio. But it's half a full position at the moment, 1.5%. And so it can go up to 3. And at some point, I would expect it to. And I think when that stock turns and rips, it's 30, 40, 50% gain over 6 to 12 months as they start to cut interest rates. And maybe that doesn't materialize until next year sometime. But you wanna be building that position into weakness. Clip the dividend on it and so forth. So trading and investing, and again, I'm taking you into a little bit into my lens here. So let's talk about Canada. Again, I'm not going to dig into the budget too much. I do want to wait for the experts. I'm by no means an expert on tax policy and those kind of things, and I want to read what everyone writes tonight, and I won't have a fully formed opinion until I read what the accountants firms say and some of the the legal in terms of the budget. You're not going to make a trade tomorrow based on this. We knew the bank taxes were coming and so forth. So, I've talked about for a long time, ZWU is a great yield-seeking, and I had this up as an idea a couple weeks ago, re-putting that out there. But when I put my Larry lens on it and look into it, and the reason I don't own it today is because when I put my lens on it like this, there's not one single stock in here that meets that criteria of something that I would want to own and put new money in today. Now, I own Kinder Morgan, and I owned it originally at 15 something, and I sold it around 18. So it went to 19. But I made money on it. I made a lot of money on it. And right now, the risk reward criteria just isn't good. And so I don't own it today. And so, there's an attractive yield there. But in terms of upside relative to downside risk, I just don't like it here. BCE, analysts think a year from now it's worth $67. It's trading at 72. Why the bleep, but a bleep, but a bleep, bleep would you want to buy that today? Okay, it's got a great dividend. Parent of BNN, but they make us say those things. But the risk reward is terrible here. So, low 60s, it starts to get interesting. 10% below the price target. A stock like BCE is rarely going to fall 20% below its price target because its beta and correlation is lower, and it doesn't have as much volatility, and it doesn't deviate from a value metric as much as a cyclical would, that's more sensitive to the economic cycle. So my lens on utilities is less, except for the energy plays, because those can swing wildly and they have a much higher volatility to them in general. So I do own some of these names. As I show you what's in some of my portfolio, which I will do in a couple slides from now, I own Verizon and I own AT&T right now. They're not new holdings. I'm actually accumulating them. I've been buying AT&T below 24. Below 24 gives me my 20% upside. It's not quite there at the moment. The yield got cut. That's an old dividend rate, but the dividend got cut on AT&T. It had a big shock down a couple months back, but now it's interesting, a little more interesting. Verizon, again. So it's meeting my criteria. It's not 20%, but for this bucket of companies, that number is closer to 10 to 15 range. And again, so I don't want to own ZWU here. It's not a bad ETF. It's a great ETF. It's transparent. You can see through it. You know what the liquidity is, all those great things that Annabelle talked about today. But risk reward here isn't attractive relative to other places I can get that yield and dividend today. So let's kind of look at Larry's boring portfolio lens. So how do we create our universe? So we look at where we are in the business cycle every quarter, and we look at inflation, and we look at what part of the business, are we slowing, are we speeding up, is growth accelerating, is growth slowing down, is inflation accelerating, so forth. And all those things together tell us where we are in the business cycle. There's a lot of great research, which I'm going to talk about factoring next week. Towards the end of the cycle of events here, I'm going to get into private credit markets again, like we did last year. There's some excellent yield plays for individuals that qualify for those type of investments. So I'll get into that. But public markets mostly are ETFs and stocks and bonds and such. So within the advertising and marketing group, sub-industry, 4 names that meet our criteria. So we factor based on earnings, profitability, all the metrics that we're looking on for value, yield, and we got all these different things. So depending on where we are, we take a universe of about 3,000 stocks globally, ADRs in the US and Canada, everything listed on the TSX basically, and we get rid of the bottom half. We get rid of the stocks that for this part of the economic cycle, historically, are likely to underperform. So right away, my universe gives me a probability of outperformance that's higher. And then I break it down by all these groups and I say, which is the best risk reward at any point in time? And so most of you probably don't know this stock, but it's the equivalent of Omnicom, for Europe, basically. Not to be confused with Omicron, the virus that hit me last week. A few months ago, OMC was our pick in this group, and now I own CRTO. And if you look at, again, the metrics I'm looking for, the volatility and sensitivity, the beta of this is higher than I'd like it to be. But if you look at the group, they're all kind of higher beta. So there's more volatility in this space. They are more sensitive to the economy. The correlation to the world markets are really low, actually. So from that perspective, it's a little less sensitive. Generally, pretty good yields in the sector. Being an international ADR, sometimes the data coming in isn't good for those names, and you kind of got to dig into the version that trades in France and kind of look at the yield there. And so anyways, PE is attractive. And so in the last month or so, when this thing dipped into the low term, the price target on this stock is 48.50. You know, and so currently it's a little oversold. The RSI reading's 43. But this is interesting. Now, you know, I would add this today to the portfolio. I already own it. I'm not adding to it. If it got a little weaker, I would add some more to it. But it's 0.5%. This is not an important group to the world. You know, the important group, semiconductors, banks, the weightings are bigger. I own 3 or 4 or 5 of them, not just one. And so depending on the group, we think a little bit differently there. And so I own this one now, and it meets our criteria. But a few months ago, you know, it was OMC. And in October, November, it was OMC that met my criteria. And I own that name. And then guess what? It turns out that some good news came. The price was depressed relative to the targets. And now it starts running. And so I sold a little bit of the position in around 80, held a little bit, bought a bit more in the dip, and then it popped on earnings and I sold into it. Why? Because it had hit its 1-year forecast price target, and so there was no upside left, and the risk reward was terrible. And so again, what did I do at that point? It's like, okay, do I still want to be in the sector? And where in February, you know, can I put that money? And so this name now is attractive, and it's got upside. And I actually did an ad there, and I waited, and then it got even more oversold, and so I added in March. So that's a little bit through my lens there on how we kind of make decisions in our stock portfolios. Now, you know, I talk about making the portfolios boring, and so I wanted to highlight this group because wireless telecom is, you know, it's a good yielding sector. The dividends tend to be very, very good depending on, you know, where you are. You know, Rogers falls into this bucket, but there's AT&T, Verizon, Vodafone. So I own those 3 names now, highlighted in yellow there. You know, good dividends, risk return is good. You know, deeply oversold at the moment? No, so it's not like I'm kind of putting in new money. But in my options portfolio, Vodafone is a great volatility name. You know, when the beta is 1 or higher, it's a lot of volatility to it. It has that, you know, its core is Great Britain, and so it trades as an ADR in the US, VOD, and so, you know, half the day it doesn't, you know, there's no open market here for it. I mean, VOD trades, but, you know, the underlying stock in the UK is closed, and so it's got a lot more volatility. So the premiums you learn off of it are good. So I recently wrote in my yield portfolio that's like ZPay, I recently wrote puts to buy Vodafone at 16, and until I get there, I earn the premium. And actually, for the next month and a half, I'm earning like a little over 2%. So that's like a third of the dividend, and I'm just waiting to buy it. If it doesn't get down there, who cares, right? I own Verizon already in that bucket, and I've got a call at Verizon at 55, and I own it at average at 52.50. And so I've been harvesting the dividend off that, and every month I'm writing a call on it. couple months out, and I'm earning the yield on that. And when it gets to 55, I'll sell it. Ideally, I like to sell it at 60, the price target. But options are only listed at certain strikes, and so you got to work in that world, and depending on what you do. And so that's kind of a bit on that group. I specifically did this one because those names were in ZWU, and I mentioned that I own some of those. But my universe of wireless telecom includes the South Korean company and the Spanish company, and actually 2 South Korean companies, and the French one. So Orange. So today I don't own Orange, but Orange was one of the names we bought into the portfolio first in September. We added to it again in December, and into earnings and the earnings miss, we got out of it. Stock gets overbought, earnings are coming, trimmed it in half, earnings missed, got out of the other half. Guess what? It's coming back now. So it didn't quite get back to where I would add it because I had those other names. I didn't want to add to the sector. That's all part of the, the mosaic that comes out. So ORAFP is the French one. ORAN is the ADR that trades that you would buy in the US. So I look through to the actual stock here because there's not enough analysts evaluating the ADR, so I don't have a reliable price target. So I'm looking here for the price target based in euros that again trades in Paris. Vodafone. So here's Vodafone. The interesting thing about Vodafone's price target, it's been so far above where this stock has traded for years, and it hasn't reached it in years and years and years. So I discount that number by about 20% because it's ever only got about that close to that price target. So some of the intricacies of price targets you kind of learn with time and experience. So we had owned this a year plus ago. We had sold it again into that earnings strength, in May of last year. We bought it back in September, October, added to it November. Earnings, good earnings, stock sold off. I added to it. Still like the name. Got above 18. We sold it out, and now I'm writing options to buy it back. It was called away a couple months back in the February option call. It got into the money. We sold it. So, those are the things we do. Now, I want to take you a little bit into my portfolio here because, okay, Larry, you talk about boring portfolios. What is your performance like? So this is not available this is not what we do in ZD. Again, little over a year ago, coming out of COVID, reading on what's going on in the world, the onshoring, the whole mess. I said, Larry, you got to launch a stock portfolio. And so we did. And this is what we've done with our stock portfolio. Maybe one day it'll be in an ETF. I don't know. We'll see. Maybe we'll talk to BMO about it. I've got 3 versions of this fund. I've got the B series, which does no volatility hedging. There's some currency hedging involved in it. You can see it's a global portfolio by some of the names we hold. Look at my top holdings here. Again, stuff that's 1.5 now. Baba was 1.5 and it grew because it grew in price. And so it got close to 2 and I actually trimmed Baba back. And so Coupang is the Alibaba of Korea. So I do have growth names in my portfolio that I like. I've vetted the company. Pinduoduo is the Amazon of China. DR Horton, there I talked about DHI as being that housing exposure. There's your AT&T that I have, Stanley Black & Decker, Skyworks, which is a solution provider for Apple phones, Volkswagen. Volkswagen is going to be the European Tesla. I believe they're going to compete aggressively across all their fleet lines. CommScope is a name. It's a bit of a value trap right here. It's got tremendous value. It's beating me up. It's a name that I'm underwater pretty significantly on. but I like the name. So the weaker it gets, I'm maintaining my exposure. Probably, some point in the next week or two, we'll notch that back up to 1.5%. Today, I added to JP Morgan to bring it up back to that 1.5%. KWEB is in the portfolio. That's the Chinese Internet ETF. I normally don't own ETFs in this portfolio. From time to time, we'll take a position, and we did. It was a little bit related to some tax loss selling we did at the end of the year, and I swapped out of some exposure to the Alibabas, and I bought some KWEB, and we've been trimming that position. And I see I own Baidu there, so Zimmer Biomet, Medical Supply, there's your Verizon, Pan Am Silver, Walgreens, Medical Marijuana, and Curaleaf. POSCO is a Korean steel company. And so you can see a lot of the names. They're not all boring companies. There's some pretty interesting stories here. And so this is the top kind of 30 names. We own a little over 100 names in the security. So the B series of the portfolio, that's the burgundy line there. That we do currency hedging, but we don't hedge market risk. We rotate in and out. So the global equity benchmark, the VT, the Vanguard Total World ETF, is the gray line, the darker gray line there, where the return annualized since we started the fund, 10.46. Our B series is doing 25.6%. Year to date, 5.81% versus the global equity VT ETF minus 5.47. So I love ETFs, folks. I love them. They're never going away. They're great ways to invest. I think the dynamics of the world have changed a little bit in the last year plus, and I think part of your portfolio, stocks make a lot of sense. And again, we launched this for the clients in the Q Wealth platform, and we talk about that a lot. Then we have this H series. So what's an H series? What does that mean? That allows us to take the core portfolio, put a volatility hedge over it so that the client will get the experience of a 60-40 portfolio, kind of from a volatility standpoint, but still all equities. Remember last year I had talked about these collars and caps and put strategies to buffer. So that's what that H series does. It does a rotating buffer, if you will, on the overall portfolio to deliver that lower volatility experience for the client who doesn't want or can't handle all equities, but 40% of your portfolio in bonds is not attractive. The benchmark for the global 60-40 portfolio, stocks and bonds balance globally, is down 5.63%. And since we launched this fund, up only 3.2%, where the H series has done 19.44%. The A series is a hybrid, and it's going to generally be between the B series and the H. In the long run, I hope it's going to be more than the B, but this is where we take our Pro Eyes indicators, and when the Pro Eyes indicators say high risk, we add these volatility buffers like the H onto the portfolio, and when the opportunity's there, we take them off. So it's a hybrid, and in terms of what so you can see that it's been similar to the H since we started, pretty much right on, a little bit better, but pretty much right on. Last month a little bit better. Year to date, not as good. And you would say, well, why isn't not as good year to date? Because a lot of the hedge in a down year like we've been experienced has added a lot of protection where we haven't always had that hedge on in the A series, but we have for some of the year had partial hedges on, and that's why the A series is better than the B series that never has that hedge. So we have one fund with different ways of owning it, and how unique is that? So this is something that's new to Canada. It's something that we launched, and if you are interested, again, reach out to us and maybe we can help you do some of these things. But this is what I do in the portfolios. Let me dig into some questions now that people have written in. I spent a lot of time on this. We don't actually have a lot of time for questions. And I'll try to go through them fast. Will the rebuild of the post-war Ukraine add to the inflationary pressures? No. Ukraine's economy is part of the world. Russia's never coming back for decades into the world economy, and there's going to be a permanent detraction from Russia's contribution to the global economy. And it's certainly a rebalance, and it'll take some time for that to happen. Rebuilding Ukraine's devastation, it's the equivalent of, I don't want to demean it at all, but it's a small part of the world, and so when you look at the number as a percentage of the world, it won't mean that much. So, but the destruction of the Ukraine is certainly adding to it, and the ongoing concerns there, as I've talked about. Is there an ETF which focuses on anti-aging theme? And if not, is there a biotech ETF? So I saw this question came in, and I did some research here. And so Globex has an aging population ETF. So it's an exchange traded fund that factors into the aging population. And so, when you look at the holdings and the allocations, there's some biotechs in here, largely speaking. And so that's a big thing. And I think that was the question. Pharmaceutical, healthcare products, biotechs, real estate, REITs, so maybe some seniors homing, healthcare services, and so forth. So maybe AGNG is something you want to look at. The person who asked that question. Next question. ETF's been taking a cold bath this week. Is it all Ukraine, or is there other variables? It's the interest rate. It's the real hawkish talk coming out of the Fed. Ukraine it's the impacts of it is not fully in the market. The shock of it was the decline in the first half of March. The realization that we're not going nuclear was the recovery. The ongoing implications for inflation have yet to be priced in. That's kind of my lens there. As we head into the US midterms, what's the typical market behavior in years of major elections? So again, prepared something here. Where are we here? Where did I go with this one? Here we go. So on my Pro Eyes, let me blow this up here. So there's two cyclical factors that we look at in our Pro Eyes indicators. And so what we're doing here is, in all years combined, based on the 4-year presidential cycle, what is the 1-month forward average return at any point in time? And that's what this is measuring. So when that return is a month out is higher, opportunity. When that return a month out is negative or lower, concern. How about the second year or the midterm election years? So that's what this is. And when you look at that lens, the first half of the year is crappy is probably the best way to describe it. As we get closer to the election, as bad news gets priced into the market, whatever, better markets, following, better opportunity following that. So, caution for sure up until some point later this year. The seasonals turn better after that. Year 3 of the presidential cycle and year 4 tend to be the best. And so, possibly good news coming. Maybe the recession kind of gets priced in. That'll factor a little bit into the end of the year, depending on, how much gets priced in between now and, say, the election. So great question. Right now, the lens, the expectation are Republicans will control both houses of Congress. and Biden will lose any power he has and lame duck for the second half, which means, probably less Washington and more business and economy. And so it does bode well, 2024 looking and beyond economically and coming out of whatever recession the Fed causes here. Fed announced they were tightening, and for the layman, as an inflation, what can we expect in market response? Any way to protect myself? So a lot of the things, again, the next few weeks and what we've talked about so far is about inflation, what it's going to mean. Are bonds a place to be? For the first time in my balance fund, I started to add some yield into the portfolio. Let me bring up my long-term bond chart here. TLT, you'll all know, is an ETF that I use for trading long bonds. I first added in here, didn't quite get to the point where I wanted to trim. World's not perfect, so we didn't cut any. So I built some duration in here. Today I added more to it. Got a nice reversal pattern here off the lower band. How low is it going to go? We don't know. When we look at that yield chart, so if I can, quickly bring up that yield chart, I know we're running long on time. USGG 10-year. When we look at that 20-year, 10-year bond chart, and we go back to 1999, and we look at this range, what chart level jumps off to us? Clearly, getting close to 3%, which would, be a decade highs. I remember Jamie Dimon in here was the Fed was tightening. Remember, this market here, 3%, Fed tightening, equities caved, Fed had to start easing. This will happen to the bond market at some point next year, later this year, that I don't know. But it's starting to get interesting, certainly more than it was when yields were down here, and I hated duration and bonds, you don't want any. I started to like them again. I don't like bonds, don't get me wrong, but if I have to own bonds in my portfolio, I'm now starting to add bonds with duration. Folks, we're out of time. Thank you so much again for all you do to support me at BNN and watch and learn. Please make a donation to the Sick Kids or Baycrest. I'm thrilled to match it. Visit one of our partner companies, see if they have something to offer you. Have a great week, everyone. Be safe.